On 1st June 2011, this company acquired 80% of the equity share capital of a Stanford company. Okay, so they acquired 80%. At the date of acquisition, which is 1st of June 11, the fair values of Stanford company's net assets were equal to their carrying amounts, with the exception of its property. Okay, so their assets were equal to their carrying amounts. I mean, the fair value of the assets of the acquiree company, the company that is being acquired, Stanford company, its net fair value of its net fair value of its net assets were equal to their carrying amount. But they have an exception of the property. Hmm. The property had a fair value of 1.2 million. So they have a property which fair value was 1.2 million below its carrying amount. Okay, okay. So fair value of the property was, so we can say like minus 120,000 from from the carrying amount. The property had a remaining useful life of so they have useful life of 8 years. All right. What effect will any adjustment required in respect of the property have on group retained earnings at 30th September 2011? What effect will any adjustment required in respect of the property have on group retained earnings at 30th September 2011? What effect will any adjustment required in respect of the property have on group retained earnings at 30th September 2011? So they are asking at 30th September 11, uh, do we need any adjustment in respect of the property on the group retained earning? So because they acquired it on 1st June and their fair value is less, hmm, so um, the acquirer, the company who is acquiring, what should they do? Hmm. So because the fair value of their property is 1.2 million lesser than its carrying amount, its depreciation will be lesser, you know. So we will need to adjust the depreciation because over the 8 years it will reduce. So it is 1.2 million and the useful life is 8 years. So over this period, like every year, they will adjust by 8. No, we take this and divide by 8. So every year 150,000. So yearly this will be the thing, and so I mean per year they will do this much of adjustment. So monthly they will do this multiplied by 12, and then because we have 4 months from June, on this date they acquired, no, on June they acquired, and 30th September they are closing the books. So June, July, August, September. So for 4 months, they will have to, for 4 months, January, June, July, August, September. So for 4 months, they have to adjust their depreciation. So 1.2 million divided by 8, hmm, and then divided by 12, right? And then multiplied by 50, multiplied by 4, sorry. So we will get this 50,000. So depreciation will reduce by 50,000. Hmm. Here is a cash though, because this is 80%, I mean, they are not acquiring completely, only 80% they are acquiring. So we will multiply this by 80%. Okay. So depreciation will reduce by 40,000. In then this is the impact on the depreciation. So if depreciation goes down, they are asking the impact on the retained earning. Actually, if you read this, what effect will any adjustment required in respect of the property have on group retained earnings? So on the retained earning will increase because your expense is going down, so your retained earning will increase by 40,000. Okay, so 40,000 will be the answer.